And a very good day to everyone out there. We're going to continue with our part 4 of our lecture and examples on MFRS 141. Yeah, part 4. We are now at slide 39. And this part is going to discuss mostly examples. And we will start off with example 2, which is on recognition and measurement of biological asset. So we have a company, Danish dairy farm Berhad, cultivates cattle as livestock for meat. So it was cultivated for meat, yeah, and sell the cattle to slaughterhouse. Apart from selling those meat, they also sell the cattle to the slaughterhouse. So it will be those that generate future economic benefits. As at 31st of December 20x0, the fair value, which is the measurement required by MFRS 141, less cost to sell of the entity livestock, the whole livestock, yeah, which is the cattle, is 10,000. Right. So if you look at, before we start reading more, if you look at the requirement given here, you are asked to do things for 31st of December to 0x1. So the one that you are given here is the figure from last year or previous period. So this 10,000 is the fair value less cost to sell of the entity livestock. So this one will be shown in the biological asset. So if you talk about this year, which starts on 1st of January to 0x1, you should have already some balance in the account of 10,000. So this is the biological asset brought down balance as at 1st of January to 0x1. Okay, and that is at fair value less cost to sell. And then in 2000x1, the year that we are concerned now, there were 8 calves that were born. So 8 calves were born. On the day they were born, the entity also, notice that in that year, they sold some heifer. So on the day the calf was born, there were no price yet, but you would see that at the end of the year, there will be price for that, changes for the 8 calves that were born. So you have sold some 10 heifers. So these are what you sold off. So the heifer, 10 of them. So there will be some reduction in the biological asset. And the figure here, the one given here, this is actually the fair value of the heifer at that date. And you also incur a selling cost of 10 ringgit. So that 10 ringgit per heifer is actually your cost to sell. So you should understand the concept of fair value less cost to sell. And again, you are informed that the fair value less cost to sell as at 31st of December 2000x1 is 14,000. So this one you are already given what are the biological asset measurement as at 31st of December 2000x1. So meaning that at the end of the year, you are also given the fair value less cost to sell. You are asked to do the journal entries to record the above transaction, right? So meaning to say that you need to record the transaction that were given. So there are a few transactions here. The first one is the calf that were born. So let us look at, we erase this first so that we can record things here. Yeah, so let's record for this one first, for the 8 calf. And you also will erase the one related to wait, yeah, just bear with me. So let's look at our journal entry now. Okay, for the 8 calves that were born, this one, yeah, what you would do is you will have to see what happened at the end of the year. So at the end of the year, you are informed that the 14,000, it also includes the gain on initial recognition. So meaning to say that this is the one at the beginning of the year, but at the end of the year, it is 1,200. So this is actually gain on initial recognition. So we need to record the first transaction for this one, which is for gain on initial recognition. The second transaction will be for the sale of the heifer. So we need to record it at the fair value less cost to sell. So for the first transaction here, debit biological asset, credit the gain on fair value change. And how much? There is gain on initial recognition. And that has been given to you. You don't have to calculate. It was 1,200. That was the first thing that you need to record. And then the sale of the biological asset, which is going to be number 2. This is the one here, number 2. So we'll record them. And we will debit for number 2. Debit bank. We will also debit our selling costs. And because that is our revenue, we will credit revenue. So what you need to do is you need to first take the figure given, which is 10 heifer times 200, which is the fair value, and then less cost to sell. So if you can do it here to make you see better. Okay, so let's do it here. Okay, so we will do it here. 200 minus 10 times 10. So that one is the proceed that you get in your bank. So that one will be 1,900. And for the selling cost, it would be, this is for the one in the bank. But the second one would be 10, which is the selling price times 10 heifer. So that will give you 100. So the revenue that you would record would be 2,000. And this will go to the SOPL. At the same time, when you have recorded the revenue, you are actually recording revenue from the sale of biological asset. So therefore, you need to record now to recognize the cost of sale. So we will debit cost of sale. And since you go and dispose or sell the biological asset, you need to go and credit the BA or biological asset. How much? It was 1,009. 1,009, which is at the fair value less cost to sell. So that was number 3 actually. And then the last journal entry would be to record the fair value gain or loss. So we will have to see that in our next slide. Let's see. The requirement given here is to record the journal entry, and we have done 3 of them. Let's look at the 4th one here. So this is the first entry that I have done with you, which is the recognition of gain. on initial recognition. And the second one is the journal entry related to the recognition of sale of the biological asset. The third one relates to the recognition of cost of sale. And now we are looking at what are the gain or loss on the fair value change of the livestock, which is the herd. And if you look at the figure given, you are given 14,000 to be the one at the end of the year, meaning that as at 31st of December, X1. The one at beginning of the year was 10,000, and that was as at beginning of the year. This is from the biological asset account. And you are informed that there was a gain, yeah, but the gain reduces the biological asset. So this is 1,900. This is the gain on initial recognition. And our focus is to find what are the gain on fair value changes, which is on the reporting date. So if you do that, you would need to also add minus 1,200. So sorry, this one is the cost of sale. So minus 1,200, which is from the entry here. This one, right? So the first entry versus the third entry. Okay, if you do that, you will get 4,700. That is the gain on fair value change, and this is the one that will be shown in the income section. So that was for the gain. If you get a loss, you will have to do the reverse journal entry. So those are the gain on fair value change. For the change in terms of the biological asset, and there's another one gain on initial recognition. So let's look at the biological asset account given here. As I said, this one is given in the question, beginning balance. These are our record when we recognize the cost of sale. This is our record when we recognize our gain on initial recognition, and the different or the balancing figure here is as a result of what you have as recognized as fair value change, yeah, gain on fair value change. Please note that the entity measure the biological asset, yeah, including the 8 calf born during the period at fair value. So in this 14,000 here, it has also included the gain on fair value change as well as the gain on initial recognition. So that has been included, but the total is 5,900, the gain on fair value throughout that year. And let us look at the effect in the statement of profit or loss. So revenue, we are trying to find net profit from the farming activities. Revenue are being recorded there, and then other income is the fair value gain, which is as a result of 4,007 plus 1,002, and this is from the cost of sale, and this is from the selling expenses. So your net profit from farming is 5,900, and that will be added to the maybe the profit from other sources. Next, biological asset that will be shown here must be at fair value less cost to sell. That is given in this question. You are given some question you may have to work out. So we'll see this kind of question if it's not given. Okay. Next is to look at the third example, which will be our last example, is about Marsha that bought a sheep. So when Marsha bought a sheep, that is not through biological transformation, but because of the purchase or new acquisition. And it was at a cost of 60,000. So when this happened, this is on 1st of January. So this one is acquisition of biological asset. And our current period here is 31st of December 20x8. So for this transaction, debit biological asset 60,000, and this is at cost because maybe fair value cannot be measured reliably. And you will credit bank or you will credit payable with also 60,000, and that have given rise to the biological asset. And the sheep that was acquired by Marsha is engaged in a sheep farming. So sheep farming is actually an agricultural activity, and the farming is not to get the milk but for wool. So wool will be the agriculture produce. So the sheep is the animal, right? Living animal, and this is the biological asset. But the wool that is shaved from the sheep, this is agricultural produce, right? So that was the purpose of sheep farming. On the 1st of December, similar sheep with the same physical characteristic, it has a fair value of 67,500. So this is the fair value. And the cost to sell given here is 3,400 cost to sell. So what you need to understand is you need to understand that there are two fair value given. One is on 1st of January. There is no fair value. So therefore we are going to compare this with the carrying amount given. So we're going to look at changes in fair value, but there are no fair value, so the cost now will be the carrying amount, and we will compare the carrying amount with the fair value that is available later. And this is 60,000. On 31st of December 20x8, the fair value less cost to sell. So fair value was 67,500. Cost to sell was 3,400. So you'll get 64,100, right? So the difference is 4,100. And you can see that the fair value at the reporting date is greater than the fair value at the beginning of the year. And therefore, there is a gain on fair value change because the fair value at the end of the reporting date is greater than the fair value at the beginning of the year or the most recent reporting date. For this fair value, so this is the first journal. So the second journal would be to record the gain on fair value change. So debit biological asset with 4,100 and credit your fair value gain. Fair value gain here is on fair value change, right? So this will be in your SOPL, and this is under income. How much? 4,100. 4,100. So let's look at the requirement. You asked to explain the accounting treatment. So you have to explain that in accordance with Mfrs 141 and also to prepare the journal. I've already prepared the journal for you, but you want to see the proper presentation. Let's see that together now. Right, the first part is to explain. So when you are to explain, you need to mention that is to be recognized as biological asset and give the reason why. So that is because it is a living animal. Remember, biological asset can only be living animal or living plants. that are managed by the company under an agricultural activity. So, but here the agricultural activity, agricultural activity in our case here, activity that is managed by the entity is sheep farming. But more specifically, that is not for milk, not for meat, but for wool. Maybe the wool will later be turned into a jacket or maybe turned into a carpet whatsoever. And that was initially measured at cost, right? So it was measured at cost. And then at the end of the reporting period, you have a gain in fair value, gain on fair value change. So let's look at what is given. So the figure here shouldn't be 120, it should be 60,000. Apologize for the mistake, because I have wrongly copied. So it should be 60,000. At the end of the reporting period, on 31st of December, there was a gain in change of fair value. So you need to explain what you have journalized just now. So you need to give the amount, how much, and show the calculation. I've earlier shown you the calculation. And what is a treatment recognized as an income? You need to mention that you compare actually the carrying world amount given with the fair value given, and that is going to be 4,100. And the value that you will show in your biological asset as carried down balance would be 64,100. So biological asset now will be this 60 plus this 4,100, and that one will be shown in your extract of SOFP under non-current asset, and that is going to be how much? 64,100, and that will be your biological asset. Whereas this 4,100 will be shown in your SOPL, part of other income, and that is actually income of the farming activities. These are the presentation for biological asset and those related to biological asset. So you may have bearer plants. As I said, bearer plants is not within the context of biological asset in terms of its accounting. Bearer plants are biological asset, only that is not accounted under MFRS 141, because bearer plants are accounted for under MFRS 116. It is still a biological asset, only that it is not accounted for under MFRS 141. And biological asset that are going to be harvested more than 12 months from the reporting date, like durian trees, like rubber trees, those will be classified as biological asset, non-current asset. However, if you have biological asset that can produce like perennial cropping, which is for maybe every 3 months or maybe every 6 months or every month, right? That is to be harvested within 12 months, right? So that has to be shown as current asset. Let's say you have a livestock like chicken that have to be slaughtered within 12 months, or maybe annual crops like wheat that will have to be harvested within less than a year. Those should be put under biological asset. And then you may also need to look at the inventory section, because there will also be inventories being produced from the agricultural produce. Let's say the tea leaves will be turned into finished product tea, just like Bo tea plantation. The tea leaf will later manufacture in the factory and becomes Bo tea. And those tea that is being packed or being manufactured, those are actually under MFRS 102. But the tea leaves that were actually attached to the tree without being plucked from the the tea bush, that has to be accounted still as part of biological asset. Disclosure. So these are the disclosure requirements. You need to show what are the gain or loss from both initial recognition, right, and also gain or loss from the change in fair value during the period that you are concerned. Sorry. You need to also describe the entity's biological asset. Do you have a plant? Do you have what types of animal do you actually manage in your agricultural farm? Yeah, and the group of biological asset, any estimation of physical quantities or output during the period, right? Information about biological asset, if you have title that is restricted or is pledged as a security. You can read this on your own, right? Financial risk management. What are the commitment for the acquisition of biological asset? Do you have any maybe government grant being attached to the biological asset if you are a FELDA or FELCRA settler? So are you given that as part of the government grant? The permission to go and have that agricultural activities being done. Next, other related issues. So the government grant, sometimes biological assets are given or granted by the government. Some of them are with conditional rights, some are without any condition. So unconditional versus conditional government grant. So government grant, if it's unconditional, meaning that you don't have any particular condition to be met, and they just give you, and it becomes receivable, becomes your income. So therefore, you have to debit biological asset and credit government grant in the SOPL. Yeah. So if that is under your company, given to your company. However, if the government grant are received and there are conditions that you need to meet before it becomes your income. So therefore, the government grant shouldn't be treated as an income, but it will be treated as an unearned income. But somehow it will increase the biological asset of your company because granted by the government. Only that one is an income, the other is not yet as an income until the condition is being met. So it is treated as a liability. But here is an income. Next. So this one is for you to read yourself and go through regarding accounting for bearer plants. I have already prepared for you this coconut plantation in Bagan Datuk, Perak, and has something to do with land and the coconut tree. Please feel free to go through and read and understand this example yourself and see why coconut tree does not meet the definition of or cannot be accounted for under Mfrs 141 is accounted for under Mfrs 116. Go and check it out that all the conditions under bearer plants are being met, right? And see that coconut tree are also being depreciated, right? Because coconut tree are PPE, right? And then the land that is used to grow the coconut tree is not a biological asset, but that is a PPE. So go and check the presentation here. And that's it. We are done with our topic. Go and do more questions to get those level of being able to do question. You need to go and practice more. Go and read and read. So read will help you to understand more. Okay. So thank you for watching. I'll see you when I will see you. Go and learn. And Assalamualaikum warahmatullahi wabarakatuh.